Live from New York City this morning. Good morning, good morning. This equity market trying to bounce, encouraged by some decent tech earnings from Microsoft. Futures right now positive, a third of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, Microsoft kicking off tech earnings with a bang. First Republic considering major asset sales, and McCarthy pushing for a vote on his debt limit plan. We begin with the big issue. Big tech delivers big beats.
Microsoft and Alphabet,
they've essentially delivered
very strong, dominant market positions.
That, I think, rally for mega cap tech can probably go a little bit further.
I think there was a lot of fear kind of going into earnings.
Overall, we're starting to see some stabilization.
Clearly, they were able to meet those expectations.
We know that tech companies have done a lot of cutting since the end of last year, early this year.
You've seen them cutting headcount dramatically.
They already ripped the Band-Aid off on guidance.
Got strong balance sheet companies, highly cash generative, with relatively stable growth.
We've seen the market more recently prepared to pay up for characteristics associated generally with growth stocks and with tech.
It's still early in the early earnings season.
We've got a lot of tech companies. This is going to be a huge week for stocks.
It's a huge week already. Joining us now is Brent Thill of Jefferies. A busy afternoon for Brent. Brent, wonderful to catch up with you, sir, as always. Just going through the names under your coverage. Google a buy, Microsoft a buy, Meta a buy, Amazon a buy. Did you like what you heard yesterday?
We liked what we heard. We think ultimately the fear going in was way stronger than what happened. The positive results from both Google and Microsoft. I think Microsoft is the standout, where you're going into your seasonally strong fourth quarter. AI is starting to have an impact on the Azure business. It still hasn't hit the application business. We raised our price target to 350, and we ultimately believe there's a tidal wave of AI activity that's about to hit, and there are very few ways that you can play this trend. Microsoft was executing well ahead of AI, and now they're ahead leading the charge in AI. They didn't lead the charge in cloud. They kind of caught the wave late. They're now way in front of this, and I think investors need to be in front of this as well and continue to be long the stock. Google, we think, was fine, but I still think there's concern around their spending. Are they behind in AI? And again, some of the lack of the disclosures and the lack of color around the business still has investors still questioning a bit. So a good print, but I think that ultimately the confidence is so much stronger with Microsoft's quality management team, the quality of the guidance, and the quality of disclosures that, at this point, it's really hard to bet against the Microsoft story here.
Let's just sit on that name and explore that story further. Nadella saying all the right things yesterday, a generational shift in search because of AI. Brent, I'm going to ask you a question that you've posed, your own question, if you will. Do those numbers yesterday even matter, given what this stock is trading on right now?
They don't. And we said going in that it doesn't really matter because the shift is in what they're going to do with OpenAI going forward. And all the pricing and all the economics still have yet to hit. And so ultimately, yesterday, the results were better than feared, and that helps the story that everyone was excited. No hedge fund wanted to short this. No long only wanted to sell this. They wanted to load up more and continue to be long this into this cycle. So we look at this. They have not unveiled any of the economics yet for their application business. They still have yet to see all these software companies that are embedding OpenAI in the fabric of their products, the economics from those businesses. This is all to come. And so, it's rare you can see, the ultimate kind of next couple years that unveil for this, which is they just get stronger and they get not only in their infrastructure business with Azure, but in their application business. So they have products called Copilot that let productivity workers do their job easier, faster, developers write code faster with Copilot. And some of the Copilot pricing, doubles the pricing of the product and in terms of seat count. So, if you were spending $20 a seat, you could spend 40 with it AI infused. So when you look at some of what's about to hit, it's rare where you can actually see this far ahead. And we don't believe this is hype. We believe this is real. Yes, we got to pour a little cold water on AI that not everyone's going to use it. And ultimately, there's going to be a select number of users. But this is no doubt Microsoft's ahead of this. They weren't ahead in cloud. Nadella came in. He had to turn things somewhat around because they had not gotten off on the right foot.
Yeah.
And I think really he understands that they can't be in the wrong side of this. They're way out in front.
I wonder if that principle applies to Google on this front as well. As you say, Brent, Microsoft was late to cloud but still succeeded. Do you think we're writing off Google a little bit too quickly, too much?
I do. I think Google's going to be fine. I think they've talked about this. I think everyone thinks that conversational AI is the only AI that's out there, and ultimately, I think these chatbots are going to be helpful, but that's not going to be the only thing. Google's been working on AI for a long time. I mean, Waze has been driving your car around traffic for many years. Google's had Google Assistant on my iPhone for many years that gives me weather or updates on flights. So they've had AI. I think they got flat-footed a little bit, and they've been doing more PR in the last 2 months than they've done the last 2 years, probably, to kind of iron things out. But I think that people have definitely written them off. I don't think they're as bad a shape. Look, the vendors that have the content and the users will win in AI, and that's Amazon, Alphabet, and Microsoft.
Let's finish on Amazon. We can talk about Meta, but it's almost too easy. The stock's absolutely flying. I think the only question that remains there is whether that's a reason enough not to buy it, because we've had a massive year-to-date gain. I want to talk about the stealth rally that we've seen in Amazon that no one's talking about. Brent, everyone talks about Meta and the year-to-date gain. I've hardly heard anyone talk about the year-to-date gain in Amazon of something like 20%. Brent, what's behind that?
I think what's behind it is what's fueling the rest of big tech, right? When the bank failures hit in March, I think everyone rotated out of banks in a sector rotation on energy back into tech. They went to these big, safe balance sheet stories. And I think around Amazon, it hinges around two things. Number one is AWS. If Google Cloud and Microsoft Azure are doing as well as they are, I highly doubt that AWS is going to blow up on Thursday, right? So AWS is the cash cow. So we know that is a great source of profitability, and they probably aren't falling off a cliff. Everyone is expecting them to fall off a cliff. The expectations on the buy side are so horrible that we just now have an expectations re-rate because everyone got too bearish. And then number two is on the logistics side, they have the chainsaw out on expenses. They are cutting expenses, and this is what we need to restore the health of the logistics in retail business back to normal. And they're making these cuts. So I think the combination of AWS combined with the cuts on the logistics side are fueling more excitement.
Yep.
To your point, it's been super stealthy. No one wants to talk about it. Everyone wants to talk about Microsoft, Google, and NVIDIA and others. No one wants to talk about it, and it quietly outperformed Microsoft and Google year to date. So, a little bit tougher setup now going into Thursday, given what Google and Microsoft did. Ultimately, we think their expense discipline will continue. I think the only caveat on Amazon is if they get into food in a bigger way, that Jassy has been indicating, that's kind of the party breakup. The cops are showing up to the party on that one, which is you finally are going to restore AWS. You get the supply chain under control, and then you go into a very low margin business like food in a bigger way. They're already there. Everyone's a little nervous on that, so we're all keeping an eye on what's happening there around grocery and food.
Hey, Brent, thanks for the input this morning. Brent Thill there of Jefferies, looking back at Microsoft, Google, looking forward to Amazon tomorrow, Meta after the close a little bit later. Here's the other side of the trade. Nadia Lovell of UBS joins us right now. Nadia, you say sell into tech strength. Why?
Yeah, tech has been weak over the last week. We're seeing some strength this morning, just given how strong the numbers were. But we are more looking at it from a valuation standpoint. Valuation are quite extended in this space. This is a space that's now trading at a 35% premium to the broader market. And the top two names within the space are trading at a 45% premium. So we just think that is priced for near perfection. And so we would take some chips off the table here and start to cycle into some of the more defensive sectors or digital surveillance sector, and also outside of the U.S. I think that Microsoft is in a unique position, and we cannot extrapolate this to the broader tech sector. Of course, Microsoft has benefited from cloud and also now, excitement around generative AI. But we are seeing signs from some of the other companies in software over the last couple of weeks pointing to a slowdown in spending in IT, and also just an extension of the selling cycle and more scrutiny around some of the larger deals. And so we'll be listening more closely for the rest of the earnings season. I think the bar has been raised for a lot of these companies, just given how strong Microsoft earnings were last night, and we might not get the same follow through.
3 sectors you don't like. Tech's one, discretionaries another, financials the third. Nadia, we've got a lot of news around First Republic, one financial institution. That stock got hammered yesterday, basically cut in half. From what you see, is that one bank, one problem, or have we got a broader problem here?
Our cautious on financials, which we've been since last year, has to do with deposit costs. And we think that those are going to continue to increase. Yes, we are seeing some stabilization in the deposit outflows, but doesn't mean that it's going to stop. We still think that these deposits are going to seek higher yields elsewhere, including outside of the banking system. And if they do stay in the banking systems, the banks are going to have to pay up for this. And this has implications for margins. Also, we know that credit lending standards are going to continue to tighten, and that has implications for loan growth. And so we just think that it still remains a challenging environment for the banks, and regulatory conditions are going to tighten further. We're already seeing some banks pause their buybacks, and we're also seeing indications from some of them for slow buybacks going forward. So even the capital return story is facing some headwinds.
3,800 price target on the S&P. Nadia Lovell of UBS. Nadia, thank you, as always. Bob Michael of JP Morgan Asset Management, the CIO, joining us around the table. Bob, good morning.
Good morning. Happy to be here.
Do we have a First Republic problem or a banking problem?
Well, I think we have both, and I think it's somewhat naive to say that this is just limited to First Republic. If you step back and think about it, this should never have happened. This went after the most heavily regulated, capitalized industry on the planet, banking. And the regional banking system, I think, is quite vital to the U.S. So I think it is a crisis. I think the regional banks are heavily dependent on the FDIC. They're heavily dependent on the Federal Home Loan Bank to get additional cash. We don't know how they're going to operate when those two programs expire.
Is it a crisis that is ring-fenced, so to speak, or is it a crisis that bleeds out to the broader economy and leads to a credit crunch?
It's ring-fenced as long as there's continuous progress to some sort of resolution. And I actually don't think the savings and loan industry back in the late 80s, early 90s is the wrong thing to look at. Some sort of consolidation, some sort of agencies, a technical assistance committee at the FDIC or the Fed to help these regional banks when they see a surge in depositor inflows or outflows, or when they see an asset liability problem. Those are the kinds of things that you need. But I think what we've actually seen is that the deposit outflows just didn't occur because they occurred. They occurred because businesses and households are burning cash in a big way. And it's the higher price of everything, and it's the higher cost to finance everything. So if you're in the couple lower quintiles of earners in the U.S., we're already seeing in the Chase data that you're depleting your deposit balances because of the higher cost of groceries just to live. And businesses, as they're rolling over their floating rate funding, it's double or triple what they put it on.
Okay, this is the third point that hasn't been discussed enough. Point one is worries about return of capital. You take it out of a beleaguered financial institution, park it somewhere else. Point two is about return on capital. You take it out of a bank, give it to a money market fund. You're on to point three. You're saying that there's that much pain out there right now that we're just burning through money in the United States.
Of course we are. When you look at, you could look at our own Chase data, you could look at the Federal Reserve Board data, you see that the bottom quintile of earners have been most punished by the high price of everything. So that excess savings that they accumulated during the CARES Act, they've blown right through it. Their deposit balances are below where they went into COVID. Now, they're not frittering it away on stuff. They're spending it to live off of. We're looking at revolving credit at now the highest rate of usage in a long time. And by the way, putting more stuff on your credit card is not being used to consume more. It's going to service your debt. And we already know when you talk to businesses, the pressures they're feeling about the cash burn on the new rate of floating rate debt.
Hold that thought, because the next logical question is the Fed done? Bob Michael's going to reply to that in about 5 minutes' time. Bob Michael's going to be sticking with us. First Republic right now is down about 12% in the pre-market. Coming up, First Republic mulling a $100 billion asset sale.
They have a lot of government securities and loans that are simply underwater because of interest rate. It's important that it's not a credit issue. It's more interest rates. There's 3 ways out of this. They can raise capital, they can sell, or they can fail.
That conversation up next.
In the case of First Republic, it's impossible to wait. They need a solution, and they need one very quickly. The lack of knowledge and, of course, the lack of questions Monday night didn't help matters. And so here we are. There's 3 ways out of this. They can raise capital, they can sell, or they can fail.
From triple digits to double digits to just south of $7 in the pre-market, First Republic plunging to a record low after a very rough Q1. That stock still falling in the pre-market. The latest coming from Bloomberg reporting they could sell up to $100 billion of assets in an attempt to shore up the balance sheet. Elsewhere, PacWest, those earnings painting a very different picture. Deposits stabilizing, with leadership saying this: they rebounded nicely in April, increasing approximately $700 million. Shanali Basak has more. Hey, Shanali.
Hey, John, it's certainly a tale of 2 cities here. We were looking at 2 banks that the market was very worried about. PacWest down more than 55% up till yesterday, now jumping more than 14% pre-market, as it shows that not only have deposits stabilized, they're also coming back at the beginning of April. Now, over at First Republic, you have a stock that was down more than 90%. As you say, it's still dropping pre-market. And the problem here is the story moving forward. Now, the big overarching question is, what is the regional banking model? How do these companies make money moving forward? Their credit ratings are certainly under pressure. And here's the real difference between First Republic and PacWest. PacWest was already a firm that announced a partnership with a private capital provider here for a credit line. We know that private capital is standing on the sidelines looking to get into the banking system, but it's not true for everybody. The more that we see trouble ahead, the more the story is difficult to unfold. Certainly that's the case for First Republic. That $100 billion asset sale figure is just one option of many. The question is, if it remains a standalone bank moving forward, what is the business model? Of course, we've seen a series of downgrades for that bank already through yesterday, but until the story going forward is clear, what is First Republic tomorrow, that it's hard to get people back into the stock.
The only clear thing right now is this is painful. Shanali, thank you. That stock is down by 12.6%. As Gianni Montgomery Scott put it, the analyst over there, 3 options on the table here: raise capital, that's difficult, sell assets, or fail. That's what's on the table for that institution right now. The name is down by a little more than 12% in the pre-market. Back with us, Bob Michael at JP Morgan Asset Management. Bob, I left the question on the table about 5 minutes ago. Let's answer it. Is the Fed done?
No, the Fed's not done, because the Fed looks at coincident and lagging indicators. So the things it's going to gravitate to are the low level of unemployment in the U.S. They're going to look at some of the tech earnings of the last couple days and say, it still looks pretty good. We need to continue the pressure. So I think they'll do one more. I think it's entirely unnecessary. I think the last rate hike was entirely unnecessary. I think the cumulative and lagged effects of monetary tightening are here. Everything we look at, which is a leading indicator, has rolled over in a massive way.
Leading indicators rolling over. When does the Fed get to look at those leading indicators as lagging indicators? When do they start to realize that? Is it the summer, after the summer, September?
I don't know. They must have models, right? Because we look at things like continuing claims. And if you look at the change in 6-month, 9-month, or 12-month continuing claims, they've risen at a rate you've only ever seen in recessions. When we look at the senior loan officer surveys, and you see that 48% of respondents are tightening net credit conditions, it's only been that high in a recession. Then you look at the conference board data. You look at conference board leading indicators. You look at current versus future indicators. All of those things are in recessionary levels. There are a handful of things that are saying we're in recession right now. If we're looking at them, the Fed should look at them and put some credence behind them.
So you've got a call, I believe, for a rate cut in September. Is that right?
Yes, we do.
What's inflation look like when they're cutting rates?
Well, that's the other thing that's happening. Inflation is rolling over in a massive way. And again, there's a whole range of data. We think by the time they cut rates, it will be below 3% on both the 3 and a 6-month annualized run rate. If we look at things like core CPI, ex-shelter, the trailing 6-month annualized is 1.8%. That's down from a peak of 7.6%. You look at Case-Shiller housing data. From a year ago, home prices are only up 0.4%. You look at the National Federation of Independent Businesses, plans for price changes over the next 3 months are the lowest level, only at those levels in recession. I could keep going on and on
Sure.
and on, but there, look at oil rolled over again, despite the production cuts. So all of these things are happening right in front of us. We look at supplier delivery dates. They're now the lowest, it's the lowest time to receive your supplies since 2009. Recession. The data is right there in front of us.
You want more time to talk about it? I'm going to give it to you. We can continue this conversation in a couple of moments. Just the very idea that Chairman Powell has spent the last year or so doing his best impression of Volcker, and he's going to start cutting rates with CPI near 3%. A few months away. We're going to have that conversation a little bit more. Coming up the morning calls and later, here's the bond market call from Bob. The whole curve, the 2-year, out to the 30-year at 3%. 3.00% is the call. That conversation around the opening bow. Plus, breaking down the bond market with BlackRock's Rick Reeder later this hour. Equities just about positive. Let's get you some morning calls. Jefferies downgrading Tesla to hold, expecting lower returns until earnings upgrades start emerging. Morgan Stanley raising its Alphabet price target to 140, highlighting the company's quarterly results. And finally, BMO upgrading Microsoft to outperform better than expected results, leading at least 16 different analysts to raise their price targets following Q3 results. Up next, markets getting a boost from big tech earnings, Meta and Amazon on deck. Seconds away from the opening bow this morning. Good morning to you all. Going into that opening bow, equity futures positive by close to 0.2% on the S&P 500. On the Nasdaq, a little bit more off the back of a rally in Microsoft, up anywhere between 7 to 8% for a big chunk of this morning so far. First Republic, a name to watch that we'll get to in just a moment. That's down going into the open by about 12%. That's the opening bell in New York City. Let's get it open for you. First couple of seconds of trading on the S&P 500. We are positive by 0.23% on the S&P 500. Taking a while for me to get you a price on the Nasdaq. When that comes through, I'll get you one on the Nasdaq 100. Expecting a boost there from the numbers from Microsoft, and then a little bit later, Meta, the high-flying name in technology, second biggest winner on the S&P 500 so far year to date. Here's your move on the Nasdaq at the open, higher by about 1%. Outside of that, into the bond market. Let's look at the bond market right now together. Treasury yields, your 2-year, a break of 4% in yesterday's session, led lower by some of these regional Fed indicators that we get time to time. They've been coming through over the last couple of days, indicating a little bit of economic weakness. The 2-year's dropped to about 388 on my screen right now. The 10-year yield back down to sub 340 at 339. If you want the constructive view of things right now, one stock to look at, Microsoft, snapping a 4-day losing streak after topping profit and sales estimates. Abby has more. Morning, Abby.
Hey, John. Well, this stock is really flying on the morning. It is up more than 7%. Its best day of the year and a great quarter right across the board, and sort of surprising because yesterday yesterday, the stock traded very heavy, as you were mentioning, down for a number of days in a row, trading as though investors thought that it was going to miss in some way, but it was very clean. They beat top line, bottom line estimates. Very importantly, the cloud services unit grew by 27%. But of course, as you know, the big thing is AI. They're talking about the idea that search is going to have a new future, all about AI, and because of their ChatGPT acquisition, they're integrating that into Bing already and seeing positive results. Now, not so much for Activision. The UK has, of course, blocked that $69 billion deal of Activision by Microsoft, saying that that kind of deal would create a lack of competition in the cloud market, even though it's a gaming deal. Activision down sharply right now, down 9%. But again, Microsoft up 8%, best day of the year.
Flying. Abby, thanks for that. Big tech competition heating up. Alphabet delivering a beat in sales and revenue. Their cloud unit turning a profit for the first time. This coming as the search giant faces a major challenge from Microsoft's AI-powered search engine, Bing. Ed Ludlow on the West Coast has more. Hey, Ed.
Yeah, good morning, Jonathan. A much more muted reaction to the Alphabet story. We're just a few tenths of a percent higher, basically flat. A beat on the top line, $58.07 billion of revenue excluding traffic acquisition costs. Performance on the bottom line, it kind of dispelled fears that the generative AI-driven battle around search was impacting the fundamentals of its search business. Probably the biggest bright spot is cloud. $191 million of operating income. That is profit on that cloud business, and I believe we have a terminal chart that demonstrates that for the first time. What that was driven by, according to Ruth Porat, Jonathan, the CFO who I spoke to on the phone, was some upside in terms of revenue and volumes, but cost discipline as well. And remember, the big story for Alphabet, the parent of Google, was demonstrating the impact of cost cuts. There was a $2.6 billion one-time charge booked in the first quarter relating to severance and real estate. And then you talk about the macro picture. They did concede that actually, macro speaking, there is a worsening outlook that makes things uncertain. YouTube continued to slow down its growth and decline in growth, but the word that executives use, including Ruth Porat on the phone with me, was stabilization. Long story short, investors aren't as thrilled about the AI story with Alphabet as they are with Microsoft. The battle continues.
You see that in the stock price this morning. Ed, thanks for that. Looking forward to the coverage with Caroline Hyde a little bit later on Bloomberg Technology on Bloomberg TV at about 12 Eastern Time. Look out for that. Here's a call from the South Side. JMP Securities maintaining their market perform rating on Alphabet, seeing a number of headwinds still in place, saying this. The analyst writes the following. This report is the first sign of stabilization for search and YouTube, but advertising demand continues to face macro headwinds, and there's the potential for search to face significant change. Alphabet struggling this morning relative to the enthusiasm around Microsoft. Shares of PacWest elsewhere, and First Republic moving in opposite directions. PacWest deposits showing signs of recovery as First Republic considers an asset sale of up to $100 billion. Shanali, two different stories for us this morning.
Two different stories. You're seeing it in the trading. You have PacWest up about 10% as the market opens here. You have First Republic extending declines. Started the open at about 17% lower after a nearly 50% decline yesterday. Now, it's interesting because we have seen throughout the course of this cycle certain banks trade in synchrony. We are starting to see the pack start to separate the winners from the losers here, and a lot of it is in context of what is available to them in terms of capital markets. Until, as we've been talking about, PacWest figures out what it does, whether it is selling the bank, selling parts of the bank with assets behind it, or parts of the assets rather, or going into receivership, which, as we know, it's made pretty clear here that is the option that the government and the bank is trying to avoid. It is hard here to grasp on to the story. A lot of noise out there, John, but, you know, keep focus on the road ahead.
Yeah, we'll try and cut through that noise throughout the whole of this morning and into the afternoon. A big day coming up for First Republic, that's for sure. Bob Michael at JP Morgan Asset Management patiently waiting alongside me. Bob, let's go through this bond market together. 2-year, 389, 10-year, 340, 30-year, 365. Your call. 2-year, 3%, 3.00%, 10-year, 3%, 30-year, 3%. What is it that you see, and we could build on the conversation from earlier around disinflation, that's going to pull this curve all the way back in, 2-year out to 30s?
You know, having listened to myself earlier, I think I may be a little too high in terms of that prediction. I now worry we could be lower in yield. I think, honestly, what we're not appreciating is that we're seeing the most aggressive and pernicious pace of tightening by central banks, I think, in history. So if you look at the pace of rate hikes, you have to go back both in the US and globally to 1980 to have seen anything like this. So a rate shock is being delivered to the system in a big, big, big way. The regional banks, I think that was a large part of the problem. There will be more. We heard Ed talk briefly about Alphabet, and I think I heard property write-downs in there somewhere. There's the entire commercial real estate market we haven't even talked about. So I think the rate shock is big. I think the second thing nobody's really talking about is quantitative tightening. That's sucking the liquidity out of the system. It's draining reserves. And if you are like me and you believe in the money multiplier effect, this is effectively the money multiplier effect in reverse. On top of a banking crisis, credit conditions are tightening at an alarming rate. The Fed ultimately will see this. They ultimately will have to cut rates. They see the damage. Historically, they've seen the damage that aggressive rate hikes have created. They do want to slow down growth and inflation expectations. Recession materialized in the horizon. Halfway there, they've always cut rates.
Let's start the conversation at the front end of the curve, and then we'll go further down through it. The very front end, super sensitive to what the Fed's going to do. So the logical question for me to ask you is, what's the Fed going to cut rates down to? How do you get a read on that?
I don't know. And I don't know if going down to 3.5% from 5% is enough. Do you have to go down to 2.5%? I think the market's going to be ballparking things and saying, well, they'll probably have to take away roughly half of the rate hikes, so something like 2.5%. I think where the market will head and what we're seeing in the long end, ultimately the curve will flatten around something. I think 3% will be the opening gambit for that.
Why does that lead to a flat curve and not just a really steep one? When I look at some of the numbers that we've got from companies this week, help me go through this. Kimberly-Clark, Procter & Gamble, Coca-Cola, PepsiCo, there's 4 big companies in America. Double-digit increases to prices, no pushback from consumers. It's hard to make the argument based on that, and I know that's a very small slice of the indications, the data that we can get, the indicators, etc. But when you go through those numbers, it's very difficult to make the argument that the Fed backing away anytime soon, and the 10 years going back down to
Not
two-handle.
in the least. I look at that, I listen to some of the tech earnings, and it makes perfect sense to me. The last thing you want to give up is your brand loyalty. You'll start cutting in other places, but right now, if you like Coke Zero, you're just going to pay whatever it is for Coke Zero. At some point in time, you will see that come under pressure as unemployment goes up. Tech, I think businesses have learned in the last 20 years. If you go back to the 80s and 90s, one of the first things to be cut in a slowdown was your tech budget. We've all learned since then that actually tech is the holy grail for efficiency. That should be one of the last things you've cut. We've just run through a week where the last things businesses and households want to cut are reporting. Let's see what happens after that. I do think that we're going to see a pretty significant recession. I think it's somewhat naive to say that we've seen this massive fiscal and monetary stimulus, which we needed to get through COVID, and now we're going to withdraw it. And we said 18 months ago, boy, when it comes out, it's going to be a painful adjustment. And now we're saying, oh, no, it'll be fine. It'll be soft landing.
Short and shallow.
Yeah, ridiculous.
That doesn't resonate with you?
No, I think it's going to be a fairly moderate recession.
Okay. So when you look at the yields right now, the 10-year, you say your target might be too high, 3.00%. You really want to put someone on the spot. You ask for a price and a time horizon. So you've got to give me the time horizon. How long is it going to take for this to play out?
So I think I've been pretty good about giving a time horizon.
You think the next 3-4 months?
Yes, historically, from the last Fed rate hike to recession, it's averaged 13 months. We're saying that the last rate hike will be in May. By November, December, you'll be in recession. So we've compressed that because of quantitative tightening and the rate of increases in central bank rates. And we've also said midway to recession, the Fed starts cutting rates. That's how we get to something like September. I've been out meeting with clients in the Midwest, the West Coast, overseas. I'm hearing the same thing. We're underallocated to fixed income. boy, we wish we bought in the fourth quarter. We're going to wait for a backup and come into the market. I think that's one of the things that starts driving rates lower.
Okay, in treasuries, just finally on credit. You hands off right now, backing away? If you're thinking recession's coming, you're not touching high yield, are you?
I'm not, and believe me, our beloved high yield team in Indianapolis pleads with me about it's a better quality universe, and on and on and on. All true. All true, default rates may not go to where they once did in the past, but even in the worst of times when default rates went to 10%, the other 90% of the market priced to 70 to 80 cents on the dollar. We've not seen that yet. We look at the leveraged loan market, only 12% of it is priced 80 cents or lower. When the entirety gets into that 70 to 80 cents range, then we'll know that we're in recession.
This is pretty bearish stuff, Bob Michael. A clinic, as always. Thank you, sir, of JP Morgan Asset Management, the CIO. Coming up very shortly, Rick Reeder of BlackRock on this. Speaker McCarthy giving into pressure and changing his debt limit bill.
This week, we will pass a bill on this floor that will lift the debt ceiling.
The update from Washington, up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, former Bridgewater CIO Bob Elliott. That conversation at 2 p.m. Eastern, 7 p.m. in London. This is Bloomberg.
This week, we will pass a bill on this floor that will lift the debt ceiling, something the Senate has not done, something the President has not negotiated, and send it over to the Senate. Because we think this is a responsibility.
Speaker McCarthy making last-minute changes to his debt limit bill, hoping to garner more support by amending work requirements and ethanol tax breaks ahead of a vote this week. This as President Biden pushes back on the proposal, the White House writing in a statement that he would veto the bill if it's brought to his desk. Anne-Marie has more. Morning, Anne-Marie.
Good morning, John. What you're seeing from Speaker McCarthy is really he's caving to his conference. This happened overnight, just hours after he made that statement to reporters saying he would not entertain any changes to his debt ceiling bill, but he did just that. And in this one amendment, what you see is some restoring of these tax breaks for biofuels and investment in biofuels. This really irked Midwestern Republicans. We also see an acceleration of the work requirements in Medicaid from 2024 to 2025. But it remains to be seen, even with these amendments, if McCarthy was able to shore up the votes he needs to get it to 218, and Jonathan, still to be determined whether or not he puts that bill on the floor today for a vote.
I cannot believe we continue to play this game. Anne-Marie Hordern down in Washington,
D.C.
I know, but you can tell I'm already getting frustrated about it. AMH in Washington. I think a lot of us are going to get frustrated about this. Joining us now, Rick Reeder of BlackRock. Rick, fantastic to catch up with you, sir, especially when you're on the road meeting clients. We appreciate it, sir. Let's start with this. This debate around the debt ceiling. Rick, is it any different this time around?
So can you put me in the camp of frustrated as well? Because we are going to go through it again. Is it any different? I would say you have a more strident set of polarized opinions on both sides of Congress, which makes it and the administration to make it incredibly difficult. My sense is they're going to come to a resolution. My sense is they're going to take us through the mud before we get to that place, and but it's going to be frustrating along the way. You think about the other duress in economy slowing, financial credit contraction. It's just not something the market needs at this point, but my guess is we're going to get some of it.
So let's make a call on the Treasury market. You heard Bob Michael of JP Morgan Asset Management a little bit earlier this morning. In this hour, looking across the curve, Rick, 2-year out to 30-year, seeing 3% and maybe even lower, Rick. When you hear things like that, Rick, what are you thinking?
So, I mean, listen, I think the direction of travel is the economy slowing, credit contraction, financial transmission is changing. When you shock interest rates this high, you do create a dulling of economic activity, and I think that's right. So I think rates are coming down, and however, I mean, you have to put in a perspective where we were last week and this week. I mean, last week, it was pretty incredible when the deposit situation appeared to stabilize, the banking situation. There was a lot of selling of interest rates. I mean, we moved 33 basis points in the front in the last few days. So listen, I think there's a lot of smart people who I have some sympathy for who believe in this idea that inflation is going to be sticky. You look at the UK, you look at Europe, and you look at wages, they are coming down. You see some improvement. Part of why I think the rate is that rates are coming down is because I think that inflation's coming down. But there's a real argument around deglobalization, infrastructure spend, keeping inflation elevated. So listen, I think you've got to be in markets like this that have no conviction. I think when rates move higher, you got to buy them. But I don't think you have to chase them when rates move down like they have in the last couple of days.
Just to keep our audience up to date on some of the moves elsewhere, First Republic in early trading down by 18%, about 20 minutes into the session. Rick, these financial struggles, I think there was a hope that things had stabilised. We could leave these issues in the background, make them history. March's problems, not April's, May's. Looking forward from here, this is the question I asked Bob. Rick, I'd love to get your view on it as well. Is that a First Republic problem, a banking problem, a Fed problem, something much broader than that?
So, Jonathan, I'm actually blown away by the incredible focus on deposits because at the end of the day, I mean, listen, I think the Fed and Treasury have done a good job of generally stabilizing the deposit dynamic, save at a couple of stress places. That being said, the bigger issue is the deposits. The cost of those deposits is well above what you're returning on your assets. So you've got a banking system that's upside down in terms of where you can accrue top line revenue, where your assets, you've got assets yielding 3.5%, and you've got your liabilities now at 5.5%. That's the issue. And by the way, the banking system is only about 15 to 20% of the liabilities, the funding in the country. Where it is, so you have a dynamic today where the funding, the costs, where the Fed has kept rates too low for long, and then they shock them higher. It will create more rumbling pressures in financial transmission. And I think it's pretty clear that you're going to take, 0.5% or so off of GDP because of tangible credit contraction, not just in the banking system, but otherwise because of that, where rates were. And now that you've shocked them higher, the rollover financing that has to happen in real estate, leverage loans, et cetera, you're going to have to start rolling over this financing at significantly elevated prices, and that's going to have an impact.
So, Rick, just to keep it super simple, you've got this asset-liability mismatch at some of these big financial institutions. They're going to have to rebalance that and sell down assets. One example of that might be, say, a bank goes out there, offers a mortgage with rates at record lows. That mortgage might have, say, 3%. Now they're paying up 4% for deposits. They're going to have to do something about that. Now, Rick, with that in mind, you're in the market to buy, aren't you? Aren't there big opportunities for you as this develops?
So, Jonathan, I mean, yes, as a matter of fact. I mean, there are, you've got to be thoughtful about supply and demand. Where is the supply coming? And try and be patient around some of these areas, but definitely agency mortgages, which have been coming out in size. We've owned some of those. We've been adding to some of those in decent size. It's interesting. Emerging markets where you don't have some of these stresses, the yields are actually really, really attractive, and the supply demand is actually in pretty good shape. So we're trying to balance all those dynamics. Listen, we're buying quality assets. I talked about it on your show last month. We're buying things like in the front of the yield curve, commercial paper at 6%. I mean, these are crazy levels. So, it's where do you want to spend your dollars today? Take some really short end of the curve interest rate exposure because the curve's so inverted, but then start to layer in things like agency mortgages, some investment grade credit to get a bit more interest rate exposure. So quite frankly, it's one of the most fun markets that I've been in a long time because there's so many dynamic changes taking place today.
So, Rick, I feel like I've been on this journey with you over the last few years. In fact, it's been longer than that. It's been much of the last decade. But over the last 12 months, I just want to talk about one way we've measured that, your risk appetite. One way we've gauged that is by your cash allocation. Rick, can you tell me what that's been doing, up or down, what that's looked like from 1 month to the next?
Yeah, so I mean, it depends what you call cash. So it's come down a lot. And it's come down a lot because we're putting so much in these front-end yields now. It depends on this commercial paper cash. It's cash-like because it rolls off in 2 to 8 months or so. So we've been putting a lot of money to work, particularly in these front end cash-like investments that are, I mean, what they do, the big challenge you have in fixed income today is if I give up some of my cash holdings like commercial paper, I'm going to give up yield to go longer on the yield curve. That's not something people are generally used to who manage fixed income. So yes, we've definitely put money to work. We're neutral in equities. I think the technicals are pretty good. The price too high from multiple point of view. So we're pretty neutral on equities. We've been buying some defensive equities, things like defense, healthcare, parts of tech, staples, but putting some money to work in equities, pretty neutral today where we were short for a long while.
Rick, just to build on that, if you do take, say, something with a maturity of 6 months, in 6 months you've got to make another decision what you do with that money again. Can you talk to me about the potential for reinvestment risk if we do indeed get a complete reevaluation of Fed policy going through from here and they do start to cut interest rates aggressively?
So, John, I mean, that's the balance that we're undergoing today, and part of why we pushed some of our exposures further out the curve, including in the last week, is to lock in. And we got the 10-year note back to what did we get to 375 last week? And it's not that exciting when you get the 10-year now under 340. So we are starting to term out some of this. By the way, the belly of the curve, sort of the 3 to 5 year point. Some of it through credit, some of it through mortgages, where we are pushing it out a little bit. But like I say, we're going to go through. You started with the debt ceiling. Like, how much risk do you need to take today when we're going to get chances to buy assets that have risk to them? So there's a balance of how much do you want to hold and just carry really well. We're trying to carry over 6% in our fixed income portfolios. You can get that by buying commercial paper. So that's the balance we're trying to manage today.
Rick, I know you've got to run. I just wanted to finish on this. Congratulations to you for becoming Morningstar's Outstanding Portfolio Manager of 2023. I will say it's early days of 2023, Rick, and you'd be the first one to say that it's not just about you, it's about the team as well. Just a comment on that, if you will, Rick. What have you and the team been doing that's led to this?
So, I don't think they gave it to us for performance for the first 3 months, which has just been okay. But no, I think, listen, I think the critical thing for investing in the last 2 years, Jonathan, and kind enough to have me on your show for so many months, is the regime shifts. I mean, we've gone through, last year we probably went through 4 or 5 different regimes. I think we've gone through 3 regimes this year. Is trying to anticipate, and like you say, I use a lot of data, use AI now, use your research around the world to try and think through what is the next regime, trying to avoid some of the noise. We live in a world now that, like, social media, it's like the theme of the day. And you got to be careful about, don't overemphasize the theme of the day, but think about what the structural influences are in the economy and then try and get positioned for that.
Hey, Rick, awesome as always. Congratulations, Rick Reeder of BlackRock. We'll continue this conversation, buddy. Looking ahead to payrolls next week and a Federal Reserve decision. Your equity market focused on one thing: First Republic negative by more than 20%. This is Bloomberg.